If you've been following the massive explosion in artificial intelligence over the last couple of years, your attention has probably been on one company.
NVIDIA.
NVIDIA, exactly. I mean,
Yeah.
it is the superstar. It's redefined the market, soaring nearly 13-fold since the end of 2022.
And hitting a, what is it now, a $4.6 trillion market cap.
It's unbelievable, and that's the headline everyone knows.
And that headline, while it's accurate, it creates a massive blind spot. I think that's the key insight from the sources we're looking at today.
A blind spot how?
Well, while NVIDIA's stock kept rallying all through 2025, several of the critical infrastructure stocks,
Yeah.
the companies that build the literal physical foundation, they actually posted steeper rallies.
Steeper in percentage terms.
In percentage terms, yes, over the last 12 months. It really highlights that AI isn't just code. It's a massive, complex physical thing.
Okay, let's unpack this. So we're specifically looking past the main processor today and focusing on that huge physical build-out.
Yeah.
So our mission is to understand the plumbing,
Sure.
the less discussed parts that are essential for a data center. And then we'll connect that demand to the geopolitical landscape that's going to shape the supply chain.
And the sheer amount of money involved is just,
Yeah,
it's astounding. You've got four of the biggest tech companies projecting collective spending of $380 billion
this year alone.
this year alone. And they expect that number to go up,
Yeah.
maybe dramatically. So this confirms AI is not just a clever algorithm, it's a massive, incredibly expensive physical project.
So what does this $380 billion machine need? Beyond that main AI chip, I imagine if you're building an ecosystem for a $4.6 trillion company, you need connectivity, speed, capacity.
All of it. And our sources really lay out five key physical components. You need high-speed memory, scalable storage, fiber optic cables, central processors, and the critical networking switches.
Let's start there then, with the infrastructure that connects everything. When you think about connecting racks of thousands of these powerful GPUs, you're not talking about, standard Ethernet cables.
Not even close.
Oh, yeah.
You're talking about speed, bandwidth, and optics.
And that brings us to Lumentum. While NVIDIA is up 13-fold, Lumentum's stock more than quadrupled this year. It's up 361%.
Just staggering. Their market cap is past $27 billion now.
So what do? They make the transceivers and the optical laser parts for fiber optic cables.
Right, and Lumentum is so crucial because of the scaling requirements AI has.
Mhm.
So imagine a single rack of the most powerful chips. It's not enough to just have them sitting there.
Right.
Every single GPU in that rack has to be connected to every other GPU
Right.
with incredibly high bandwidth and almost zero delay. They call it all-to-all connectivity.
Which requires specialized equipment.
Exactly. You need optical connections rack to rack to handle that volume of data. And then you have to connect all the racks. Entire data centers have to be connected with fiber optics.
So this is their moment.
It really is. Lumentum CEO Michael Hurlston, he said 60% of their sales now come directly from cloud and AI infrastructure. Sales surged an enormous 58% in their most recent quarter.
Wow, $533 million. That is explosive growth for a company that size. It just shows how frantic the need is for this physical plumbing. But what's the trajectory look like?
That's where it gets interesting. So revenue is expected to jump 58% this fiscal year, but analysts see a significant deceleration,
A slowdown.
a big one. It's projected to drop to 32% growth and then just 15% after that. This suggests that the initial massive rush to equip these data centers is expected to cool off a bit.
So if the optics surge levels off, what component is expected to keep accelerating? That has to bring us to what manages all the traffic, right? The networking switches. Let's look at Celestica.
Celestica is a fascinating one. It was founded back in 1994, and their stock is also up massively, 213% this year. They make the switches that connect these networks and orchestrate the data flow.
So what's driving their growth if the optics part is slowing down?
It's their connection to the custom needs of the biggest AI buyers.
You mean companies like Google or Meta building their own specialized chips?
Precisely. They are benefiting from the huge demand for custom silicon. They're called ASICs, application-specific integrated circuits.
So a chip designed for one specific purpose.
Exactly, like running Google's own AI models on their TPUs, their tensor processing units. It's less flexible than a GPU, sure, but it can be way more power efficient and cheaper for these enormous, dedicated AI jobs.
So Celestica isn't just selling a standard box. They're actually building and integrating these complex custom hardware platforms for the big cloud providers. That sounds like a much deeper relationship.
It is. Celestica's CEO, Robert Mayonis, noted their largest and fastest growing area is in high-performance networking and these custom ASIC AI compute platforms.
And analysts are seeing this?
Oh yeah. Goldman Sachs specifically pointed out that Celestica is supplying parts for Google's ASIC solution. They expect them to benefit in 2026 from being a top provider of Google's TPU rack-level solutions. This is really sophisticated, high-margin work.
So if Lumentum's growth is projected to slow to 15%, what's the outlook for Celestica?
It's the complete opposite. Celestica's revenue growth is actually expected to accelerate.
Really?
Yes, analysts see it climbing from 26% this year to 33% in 2026, and then 34% in 2027. This difference is really the key takeaway here. The first gold rush was in basic optics, but the next phase of growth seems to be in this complex custom system integration.
Okay, that takes us from how the data flows to where it actually lives. We always hear that data is the fuel that powers AI. You need immense amounts of space around
But
it.
raw training data and for the applications themselves, yeah.
Yeah. And it's almost ironic that this futuristic, incredibly expensive tech relies on some of the oldest, cheapest tech spinning platter for its bulk storage.
The irony is powerful, but it's logical. We're looking at Western Digital WDC, whose shares are up 296% this year.
And Seagate, up 228%.
Right. And while WDC makes flash drives, they are best known for their HDDs, hard disk drives. Those spinning disks are still the most reliable and cost-effective way to archive petabytes of data.
And we're talking about just colossal industrial grade data needs here.
Absolutely. WDC's CEO, Irving Tan, he gave this stunning example of a hospital using AI that has to analyze 7 billion medical images.
7 billion.
That volume just demands cheap, scalable archive storage. And that is the niche that HDDs still dominate. WDC's revenue rose 27% last quarter. They even spun out their flash business, SanDisk, to focus on this enterprise demand.
And similar to Lumentum, WDC's growth is expected to slow down from 23% in fiscal 2026 to, 13% in 2027. So bulk storage demand also seems to hit a ceiling pretty quickly.
Correct. And Seagate is seeing the same thing. 80% of its sales already go to the data center market. Their CEO, Dave Mosley, he said that AI is reshaping hard drive demand by making massive data storage more valuable.
So they're confident in the demand?
Very. Bank of America analysts noted that customers, especially the big hyperscale buyers, are signing these build-to-order contracts with firm volume and price commitments. You don't sign those contracts unless you are absolutely certain about your future data needs.
So that covers the bulk storage, the archive. Now we have to pivot to the other end of the spectrum, high speed. This is the memory needed to actually process the huge AI models in real time. And that brings us to Micron.
And this is where the physical demands of AI have created a crisis, really. We're talking about high bandwidth memory, or HBM. AI servers needed to store and process these giant models.
What makes HBM so different from the standard memory in our laptops, the DRAM?
Well, standard DRAM is fast, but it's a bottleneck when you need to feed an enormous amount of data all at once to thousands of cores on a GPU.
Right.
HBM solves this by stacking memory chips vertically, like a tiny skyscraper right next to the processor. This vertical stacking just drastically increases the data pathways. It's the difference between a single-lane road and a 50-lane highway. AI demands the highway,
And because it's so specialized, it's created a crunch.
a huge crunch. Chip makers like NVIDIA are just consuming all the available HBM capacity. It's led to a worldwide shortage, and that's driving prices sky high.
And Micron is right in the middle of this.
They're the primary U.S. beneficiary. Their stock is up 228% this year, and they just blew away Wall Street estimates.
What stood out most from what they said?
Just the desperation of the demand. Micron's business chief, Sumit Sadana, he said they were more than sold out of their HBM chips.
More than sold out.
Yeah. They even took this drastic step back in December. They completely shuttered their consumer-focused line of memory and SSDs just to save every bit of supply for AI.
Wow.
And Morgan Stanley analysts said Micron's results showed the best revenue and profit upside in the history of the U.S. semis industry, aside from NVIDIA.
That's an astonishing statement. But if everyone's clamoring for HBM now, what's the long-term outlook for Micron? We saw those slowdowns for storage and optics.
Micron's forecast is the most dramatic example of this.
Oh,
Their revenue is expected to almost double this year, riding that wave. But then analysts project it's going to slow dramatically to 24% in fiscal 2027 and then less than 1% in 2028.
Less than 1%, that's not a slowdown, that's a cliff.
It's a massive cliff.
Why such a radical drop? Do analysts think the tech will be leapfrogged, or is it just that supply will finally catch up and crash the prices?
It's mostly the latter. Analysts believe this explosive shortage and price surge is a temporary market peak. Other producers are also investing heavily in HBM capacity, and eventually, supply is expected to meet or even exceed demand.
And that forces prices and revenue growth back to normal?
Right, back to normalized single-digit levels by the end of the decade. It just reinforces this idea that the entire infrastructure segment is in a hyper-growth phase that is simply not sustainable.
Okay, so we've established this incredible immediate physical demand that's driving these companies to massive growth in 2025. Now we have to shift gears and look at the long-term strategic risks.
Right. The second dimension of this deep dive, the geopolitical stability and the future of the supply chain,
Specifically, U.S. regulatory action on Chinese semiconductors.
which raises a critical question. How does global trade policy affect a supply chain that's already stretched to its absolute limit by this AI gold rush?
So what's happening?
Well, following an investigation that started about a year ago, the Office of the U.S. Trade Representative, the USTR, confirmed its finding that China is engaging in unfair trade practices in the semiconductor industry.
And what exactly was the USTR targeting? Was it these cutting-edge AI chips we've been talking about?
No, and that's a really crucial distinction. The USTR found that China has been targeting the semiconductor industry for dominance for decades, using non-market policies and practices.
Yeah.
But the specific focus of this whole process has been on older or legacy chips.
Why focus on the older chips?
Because every single piece of hardware we just discussed, the Celestica switches, the WDC storage controllers, the Lumentum transceivers, it all relies on cheap, essential legacy components.
Ah, okay.
So if China dominates the manufacturing of these commodity chips and floods the market, they gain strategic leverage over the entire global supply chain, even if they aren't making the $30,000 top-tier AI GPU.
That puts the regulatory action into sharp focus. So, what did the Trump administration announce on tariffs? What's the timeline these companies have to plan for?
The administration announced that the U.S. will increase tariffs on Chinese semiconductor imports in June of 2027. This specific rate will be decided a month before, but that deadline is now on the calendar.
June 2027. That sounds far away, but for planning a data center or moving manufacturing, that's almost immediate.
It's the long-term deadline. But here's the crucial immediate detail, the thing that provides some breathing room.
Hmm.
For the next 18 months, so until the very end of 2026, the initial tariff rate on these imports will be zero.
Zero.
Zero. This delay signals the administration is trying to cool any trade hostilities and gives clarity and a grace period to American firms who are worried that immediate tariffs would just shatter their supply chains.
So the U.S. is basically giving companies like Micron and Celestica 18 months to diversify their manufacturing footprint out of China before the deadline hits.
Precisely. It's a strategic planning window. And it follows a trade truce that was reached back in October between President Trump and President Xi Jinping. That truce involved the U.S. slashing some tariffs and China allowing rare earth metal exports. So these future tariffs are now basically a powerful bargaining chip.
A bargaining chip that could be used if talks break down later.
Exactly. And it's important to clarify, these new tariffs are separate from other duties that have been threatened under a different section of the law.
It really is a supply chain ticking clock. All right, let's summarize what we've deep dived into today. We moved past the abstract idea of AI and really focused on the tangible physical parts, the networking, the fiber optics, the memory, the hard drives.
All the things that propelled these 5 infrastructure companies to extraordinary growth in 2025.
Right. Lumentum's 361% surge really showed that immediate need for just raw connectivity.
The physical scale is just undeniable. That huge $380 billion spending plan ensures that demand for this infrastructure will continue and continue strongly into 2026.
But
But those sharp slowing revenue projections, especially Micron's expected drop to less than 1% growth by 2028, that suggests Wall Street is already pricing in a period of inevitable market maturity where supply finally catches up. The current crisis level of growth is temporary.
that balance between frantic, immediate demand and that future normalization, it's incredibly compelling. It must create a lot of volatility for these smaller players.
It does. We've seen extraordinary growth driven by the need for physical components now. But as we look toward 2027, the long-term profitability of these massive data center projects might hinge less on technology and more on global policy.
And that June 2027 planned tariff increase is a hard deadline.
It is. So the question becomes, how will the industry, which is already struggling with supply constraints, how will it use this 18-month zero-tariff grace period to re-architect its global supply chains before new trade friction inevitably descends? That strategic move, well, that's what will determine if this infrastructure gold rush can stay profitable long after the initial build-out is done.